Oh, I was muted. All right, let's get things started. Thank you for joining us today. Glad to have everyone here. This is the Exit Advisors Town Hall series. And today we're going to be focusing on capital and investment tactics to retire. And we're joined by Mike McGee from McGee Wealth Management. Thanks for joining us, Mike. We also have Heidi Wheelberg. Heidi is with Ball Wheelberg Attorneys and focuses on estate planning. And I'll add that Heidi did a really great series a month or two ago. It's on our website. You should check it out. I kind of dove pretty deep into maybe some of the tax implications coming down and some estate planning that you should be ready to prepare for in the coming months. And I'm sure we'll touch on some of that today again. And then our managing partner, Al Danto, who's also a Rice faculty in the graduate program. So a little overview of Exit Advisors. We are a boutique M&A advisory firm. We work with clients to help prepare and get them through an exit, to get them to a major liquidity event, probably the biggest transaction of their entire life. And we've got a great team helping do this, a pretty deep bench with a lot of experience. There's Al Danto, who's with us today, Gary Cooper, one of the managing partners, also the founder and CEO of Cooper CPA Group, myself, and Casey Bright. And, just diving a little deeper into our process, we try to partner with great folks like Mike and Heidi. They are critical players on the deal team. It's not, they're very integral and part of the planning process. So as you can see, we start by educating our clients, walking them through, what this is going to look like. And this could be months or even years in advance. And then we dive into the discovery work, a lot of pre-due diligence, getting everything cleaned up and ready to go to market. And then ultimately we take them through execution. But, today's focus, it's not so much on the M&A process. It's what really needs to be considered before and everything that comes after you have an exit, after you have that liquidity event. Mike and Heidi are going to talk about, not just managing your wealth, but safeguarding it and preserving it to really get that number at the end of the day. Because as much as we focus on the transaction and getting you the highest valuation for your business and the most streamlined process possible, it really, all of it boils down to, what's your number? How do you get to that number, and how do you protect it? So Mike, I'm going to pass it over to you again. Thank you, Mike. Thank you, Heidi, for joining us today, and looking forward to hearing what you had to say.
Thank you, Andrew. I appreciate it. Thanks, Al, and the whole team at Exit Advisors. Glad to be here today. And Andrew kind of touched on this in the intro. This really is a very big planning process. If somebody's considering, a business sale, or, what am I going to do at the end of the day? This is something, it doesn't start, 6 months before a sale, most cases, or at least it shouldn't. This is something that needs to, be looked at years in advance and to start that kind of process. And so what we're going to cover today, at least on my end, is just some things that we've run across in our experience and what we've seen with working with business owners that we've been working with for a long time that are looking at an exit, and also people that are brand new to us that are going to be selling or potentially selling, and some of the things we discuss and we look at. So on this slide, this is the things to consider prior to business sale. The first bullet point, it's kind of common sense in a way, but it's something that we don't see done a whole lot necessarily. So first and foremost, we always, when we're working with business owners, we always want them to try to de-risk from the business through the years. And what do I mean by that? What I mean is doing your traditional type of savings, put some money away. Don't necessarily reinvest all of the money in the business throughout your 15, 20, 30 years in the business. A lot of business owners that we deal with and work with, especially ones that are new to us, that's what they've been doing, year in, year out. They're constantly reinvesting in the business, and their quote unquote retirement plan is, hey, look, I'm going to sell this business at the end of the day. And so what do I need to save for? That's my retirement plan. And so it's a very, very common thing that we see among business owners. So, we tell people that the business owners is like, look, if whenever you're reinvesting in the business and whatever you're doing, your ROI on reinvesting should generally be higher than what you're going to do in the outside world and the outside investments long term. You really should make more within the business, but the problem is a lot of things can happen in the business. I think last year, 2020, taught us a lot of these things, that you can have a very successful business, or things can be going very well, and then at the drop of a hat, those things can change. We had some clients that we were very fortunate that were in industries that were very badly hurt by the shutdowns, but luckily they were they actually exited a year or two prior, and they're very, very thankful for that they were able to, and they got a good value for their business. So we always tell people, look, you want to de-risk through the years, take some chips off the table. We need to do some traditional, other investing, whether it be in capital markets, equity, bond, real estate, other things, so that we don't have, all our eggs in one basket in the company. The second bullet point here that we talk about a lot with these business owners is, looking at various things, because normally as you're working and running the business, a lot of cases are going to have a higher income during those years than you're going to have in retirement. So we want to look at things like taking advantage of retirement accounts and various tax deferral options. So a lot of business owners, especially the ones that have the higher incomes, they're going to be over, potentially on a regular basis, they're going to be over the threshold for Roth contributions. So we have a lot of business owners that we work with looking at things like, look, let's start a 401k potentially for the business, so that you have the ability to make Roth 401k contributions. A lot of people don't realize that while there's a limit for Roth IRA contributions on the income side, if you have a 401k, there is no income limit to making Roth contributions in a 401k. We have a lot of people that are concerned about, what are taxes going to look like at some point in the future. And the younger the business owner, the more advantageous this is, because the longer period of growth they're going to have long term. So basically, for those of you watching right now that aren't familiar with Roth versus traditional, basically a traditional 401k, you get a tax deduction, or a traditional IRA, you get a tax deduction today on the front end for your contribution. Your investment grows essentially tax deferred until you take it out. When you take the money out in retirement, every dollar you take out is subject to income taxes at the then applicable federal income tax rate. On the Roth, on the other side, it's your contributions go in. Basically, you don't get any deduction on the front end today when you make the contribution, but it grows again, essentially tax deferred. And when you take it out, it really goes tax free. When you take it out in retirement, you don't have to worry about what the taxes are at that time. So that's a kind of a sneaky way where a lot of businesses end up with 401k, small to mid-sized businesses, is frankly because the owner is looking for a way to get some good potential tax-free growth, tax deferral options, and that's a good way. And depending on the size of the business, sometimes it's a SEP IRA or a simple IRA, various options there. But we really, work with people to try to take advantage of those tax deferral options, because again, if they're in a lower tax bracket later on in life, it's something that's very important for them. Third bullet point is, and this really gets to the heart of working with a team like Exit Advisors and things like this, is, can you net enough after tax, after a potential sale, to safely retire and accomplish any other goals? What is your business worth? For people who come in, new clients to us that have not worked with, either an Exit Advisor type group or somebody that they have an idea, they don't know what their business is worth. And I tend to find that people, and this is just human nature, tend to think the value of their assets, whether it be a house, they're selling their house, their business, whatever, they tend to inflate what they think the value is worth. But you want to, really take some time, dig deep, and look into, what is my business potentially worth at the end of the day? And this is why you don't want to be looking at this necessarily 6 months before your planned exit. You want to have a realistic idea of what's the multiple on my type of business, my industry, because obviously some are greater than others. And then this also, comes back to working with, a financial advisor or wealth manager to come in and also say, what's your budget? What do you need to have after retirement? Because, we'll have people that'll come in and say, just sit down and go, okay, if I have $3 million, can I retire? And you don't know anything about that. Well, what do you spend? What does it cost you to live on a monthly basis? That's a very, a lot of what we're talking today is a very personal question in terms of, what's right for one person and what makes sense for one person doesn't make sense at all for the next person, depending on what their, what their lifestyle is like, what their goals are, and things like that. We have some people that when we're working with on a business sale is what are your goals? It's in terms of, they want, what we joke about it is they're saving and they want to save and retire. But on the way out, they go, man, I want my last check on the way out. When I'm heading out of this world, I want it to bounce. And then you have other people that it's, oh no, I'm very concerned about, this gets into Heidi's expertise is I'm very concerned about a legacy. So, I'm willing to sell my business, but I want to be able to retire. I want to be able to live my life, and I want to make sure I'm leaving behind a legacy for the next generation because that's what's important to me. So this is where it really gets into the planning side of it and talking through all of these items because, if somebody has an offer to sell their business and they're 50 and they're in good health and they, have a reasonably normal life expectancy based on what we know today, what they need is one number versus if that same person was 65 or 70. So this isn't a one size fits all approach. And it takes a lot of planning on that side. The next bullet point is, first and foremost, does it make sense to sell the business? Again, in the example I was just talking about, if somebody is a 50, 55-year-old individual and they're looking at potentially selling their business, what can they get from it? Does it make sense to sell it? We run into a lot of people that, by the time they sell, pay their taxes, especially right now with the unknown of, is there going to be a potential increase in the capital gains rates? What am I gonna walk away with? And if I'm used to living on or making $500,000 a year, can we safely recreate that on our end? In a lot of cases, the answer might be no, but they don't necessarily need that either. So in some cases, we have to look at what are we going to do? Can we bring in a GM, a general manager, or somebody else, or some additional levels of management where they can essentially run the day to day, and the owner still maintains ownership, so they still have the asset, they still have the potential of the business going up in value and all those things, but they can they're taking out a lower amount, but it's enough to pay their bills and live a comfortable life until they are finally ready to sell. So again, that depends on the person's age, their industry, and a lot of different things. I mean, businesses, unfortunately, they don't sell for necessarily the multiple that everyone would like because there's inherent risks in business. Not only is it, hey, look, I want to sell at some point, and could the owner get sick and, the value of the business go down? Sure, that's one thing, but there's competition, there's key employees leaving. There's a whole host of issues that can arise in business that can drastically affect the value of it, or just its ability as a going concern in general. Can it continue? And so we have to look at those things, and and there's various items where we can essentially attach golden handcuffs if we need to a somebody running the business, or incentivize them enough to where it makes sense for them to, they're comfortable, they can run your business, and you don't have to worry about it long term. I mean, you still need to be there on a day-to-day basis, but you don't have to necessarily worry that it's going to be gone tomorrow. The next item, and this is more so, oh no, go ahead and go back one. Sorry. Next item is, this is more of a kind of mental health issue in terms of, are you prepared for what you're going to do after the sale? We have a lot of people that it's very difficult for them just personally to run a business, work for 10, 15, 20, 30 years or more, depending on what, how long they've had that business, and, have that grind day in, day out, and then sell the business and just walk away. I mean, a lot of people are not prepared for that. So what are you going to do post sale? You really need to think about that because, are you going to maybe seek some sort of other employment? Could it be, and we'll talk about this a little bit later, is, do you stay on with your current business? Do you go on to something else where, you might not necessarily need the funds, but hey, I need a reason to get up in the morning and get dressed and, have, critical thinking skills and do all that kind of stuff. Is it employment or is it volunteering? I've had people tell me, it's like, look, I love to play golf. I love to fish. I really have enjoyed that the last 20, 30 years, but I only did that once a week, maybe twice a week at best. And now that I'm doing it 4, 5, 6 days a week, it's not so much fun anymore. Now that's become work. So you want to think through those items and really, sit down and feel like what you're, understand what you're going to do and what's important to you and what you value and what you're going to do with that. So some people, they really, we've just seen people struggle with that some. The last item on this slide is to really look at what's your potential exit strategy. Again, depending on your type of business, and Heidi may have some additional items to add on this here in a second, is, are you going to maybe sell it to your employees, the business? Are you looking at selling this to a strategic competitor or partner that they would be a good fit for your business? Are you going to maybe pass it on to family? That has a whole nother dynamic that we're, not really spending a lot of time on, but obviously there's different considerations there if you're looking onto this for the long term and passing this on to family and various trusts and other estate planning techniques that you can work on to make sure that you're passing it efficiently and effectively with the least amount of estate taxes and other tax considerations. You want to chime in, Heidi, on anything on that?
Yeah, thanks, Mike. It, like you said, it really depends on what type of business you have. And is it a closely held business where you're going to maybe sell it to family? That's going to change a lot of the dynamics on what you're going to want as an outcome. And there's a lot of room for estate planning to partner in that arena, especially. There's different things you can do with this big concern right now of the tax, the capital gains tax that may or may not become retroactive. Do you want to sell your business and risk that? Or there's other ways that you can transfer the business or transfer the operation of the business, but you still keep the asset. You can put it in different trusts where you don't ever have a capital gains risk at all. And you no longer own the property, you no longer own the business, you don't have any sort of inclusion in your estate. So you also win on the estate tax side too. So that's just an example of something you could do. But these things you have to do ahead of time, and plan it out. The other things, that I think you were kind of hinting at or suggesting, Mike, was like the like buy-sell agreements, keeping some sort of an agreement for who's going to take over and how is it going to happen, tying that to your estate plan, having it in your, planning and for your business and your estate. And also, I just want to add in there too, even though we're talking about selling, what if you become incapacitated? Nobody plans to do that. Nobody wants that to happen, but that should also be included in your planning, just in case something happens before you're ready to retire. And maybe you no longer can run the business. Now what? Who takes over? How do they take over? How do you safely receive income and still be able to continue on? So those are all some of the things you can need to consider.
Yeah, exactly. And you know, one of the things that I was going to mention this earlier, but I forgot to, was, you know, on the third bullet point was, you know, about safely retiring and accomplishing any other goals. You know, there's a lot of things, especially depending on the business owner's age, that we have to worry about. Is, you know, things like long-term care. You know, long-term care insurance used to be, you know, very different 10, 15 years ago. So a lot of people self-insure nowadays or do other things to try to take care of that. But that's a real big consideration that people need to worry about. Is, you know, people will look at it and say, hey, look, I'm going to get X for my business, and that's only going to, you know, I can retire on that. That's fine. Or we think we can retire on that, and we're moving forward. But what if you have these other hiccups along the way? You know, if somebody, God forbid, was to get Alzheimer's, dementia, some of those facilities where they need help, I mean, those are $7, $8, $9, $10,000 a month for those items, and for those places. And so that can really, you know, kind of throw a wrench into your plans of what you were doing. So, you know, you have to talk through all of these kind of unknowns, you know, because healthcare in retirement it's a big thing. So, you know, prior to sale, and some of these exit strategies that we look at potentially are, hey, when I'm going to go sell, if I'm, you know, maybe close to Medicare age, can we structure the sale in a manner, especially with the uncertainty of these taxes, can we structure the sale in a manner where, you know, I can stay on the payroll of the business, I can maybe provide some consulting, I can do a few things here and there, but that way I maintain health insurance, I've got an income coming in, and maybe we can avoid or minimize some of this potential increased capital gains sale. So there's a lot of different considerations that we have to look at. It depends on sales price and things like that. But, you know, there's a lot of different costs once you're no longer the business owner that we need to worry about.
Right. I mean, I recently, just an example, had clients come in that said, you know, their business, they were transferring it to their son, and they only needed $5,000 a month to live on. And I said, well, what if you get sick? Oh, we're healthy. We're in our 70s. We're healthy. Never had a attack. Never had a health issue. And then, you know, you just don't know, and you don't know how long you're going to live. So, you know, I think we talked about that a little bit, or, you know, you mentioned it. Those are unknowns. And so it's hard to plan 100% for those. But your example of Alzheimer's is like it's increased 145% in the last 20 years. So that's a real, you know, potential threat to your retirement, because like $10,000, and this is going to go up, you know, a month. It's just going to get more and more expensive. And if you don't have a little bit extra cushion to save for that, you know, then you're looking at, can you keep your house? Can you keep, you know, other things? So you're putting a lot of your, maybe what you were going to pass on to your children as a legacy at risk. So I think those are all, you know, things that are important to consider, Mike.
Sure. And then, and I mentioned this earlier on our call before this was, you know, Fidelity does a lot of work on, Fidelity is a large fund company, 401k provider, but they do a lot of research on healthcare in retirement. And it's kind of counterintuitive, but when you think about it, it makes sense. Is, you know, in their research, they've figured out that, you know, and Heidi was saying this, is, you know, people go, hey, look, I've never had a health problem. I don't take any medication. I'm 60, 65, 70, whatever it is. Statistically speaking, those people actually tend to spend more money on healthcare in retirement than people who are unhealthy. From the simple fact of, because they're healthy, they live a much longer time. They have a longer life expectancy. So although on, you know, on a maybe day-to-day, month-to-month basis, they're not spending anywhere near as much as somebody who's got other health concerns, just because of the fact that they live that much longer, they spend significantly more on healthcare during their lifetime than somebody who has a lot of other underlying conditions, just because they just don't have as long of a life expectancy. And so, you know, they estimate it's at least, you know, $250,000 per person in retirement for somebody who's pretty healthy in retirement on healthcare. And so that gets expensive. You know, that's a lot of money to have saved just for one item. That's no trips. That's no changes to your house or anything else. That's just, that's just one single item.
Right. And just a personal example, my grandmother, she just actually turned 100 this year, which is super cool. But, she had 1 year of long-term care. Mm-hmm. She used it. So, then you have to make decisions. And that's what can happen if you don't have the plan in place ahead of time. We had to sell our house just to be able to pay for her care. So, these are things I see, not just in my personal life, but a lot of clients also have that happen because they just didn't plan ahead enough. They didn't think they'd live that long, So definitely a real concern.
Yeah, and I can't harp enough on this is where really it matters sitting down with a group like Exit Advisors to kind of come up with, an idea of really what's your business worth? What can I truly maybe expect to get from this? Because I feel like that's a missing piece that's, sometimes an afterthought of, people will sit down with people like myself or Heidi or whatever, but they just kind of have a total guess on what their business is worth. And, that's a really big component of it. You really got to know what that is, because for most business owners, that's their biggest asset. And so you want to know what that's worth and what you can expect from that.
Yeah, Mike, another big thing is really talk about exit strategies and whoever your target is. If you're gonna, there's an ESOP, like Heidi said, selling to a family member, selling to a strategic buyer, selling to a competitor, letting your employees take it over. Each pathway is going to have a unique set of techniques and tactics that you're going to have to do to get you in that direction, right? So it's really important to have a general idea of where you're heading with that, because it's going to be completely different. If you do qualify for an ESOP, and oftentimes we meet with clients and they don't consider their key managers as potential acquirers for the business, but they are the easiest to finance. They're the most qualified, and sometimes, given that opportunity, they're going to step up. So it's really important to kind of have a general understanding of what direction you're gonna head in. A really good friend of mine that I knew years ago, he knew who he was going to sell his company to from the day he started. He said, "Look, we're the alternatives to them. We're going to build it up," and all of his tactics and strategies were to make himself more attractive to them and more valuable to them too. So when the time came to sell, he kind of had a built-in buyer, which is completely different than if you're going to head down the direction of potentially an ESOP or even just taking the business to market, right? And look for financial buyers. So,
well, and that's where, when I mentioned about, do we just keep the business and have somebody else helping them out, is, some businesses unfortunately don't have that built-in manager that they can step up and look at those things. And so if you don't, that's something that it can take a while to find that person of, it's kind of like dating. You got to bring them in and, let them kind of work in there and figure out, is this a fit? Is this somebody that I can trust to run this, or somebody that even if I can trust them, can I deal with them? Or, personally, do we get along? And we've seen that before, where sometimes that's their end goal with a client, but it's just that's just not going to work out with that person. And so it takes a couple of tries to get there. And that's not something that just happens overnight.
Man, it's real challenging too, Mike. And you said earlier, when you run a business, you have all these inherent risks in it. Mm-hmm. And as long as you still own it, your name, you're the number one shareholder. If someone's in there running, you still have to worry about that. It's still something to keep you up at night. And if you get down the road where you're dependent on somebody and they leave or something happens, you can even be in worse shape. I mean, that's a really challenging road to go down, right?
Well, we tell, I've seen this. We've had people make these mistakes, even though you mention it with them, is, and if you have somebody else come in, you can't just fully disengage. I mean, this isn't, a publicly traded company where you've got a board of directors and you've got all this stuff. Is a big problem you see is people, they bring somebody in to manage it and work on it, and they're doing a great job. It works for a year, 2, 3, 4, whatever it may be. And they've totally disengaged. Their customers no longer see them. They don't even remember the name. New customers don't even know who they are. They just know the manager, and then or whoever's running it at that moment in time. And then that person leaves, and owner tries to step back in. Well, it's too late at that point. And so that's a big consideration too for some people, is like, hey, it's easy to say, just let's bring somebody else in to manage this. But if the owner is not willing, or, they're just burned out and they just go, look, I just got to be done. And you can't stay at least somewhat engaged in front and center, so everybody still knows you're there. That's a real problem.
Exactly.
If you do find that person and you want to hang on to your shares, I kind of mentioned a little bit earlier, you can use a lot of trust planning to avoid this whole income tax issue that we're looking at right now. That we don't know. It's definitely an unknown. Capital gains, are they going to go up? Who knows? But if you want to completely avoid it, you can use different trust vehicles to transfer the ownership, still remain the owner, but through a trust, and still continue to get an income stream. And then you could slowly even sell the assets out of the trust to whoever that is, and do that over time to make sure it's the right person before you totally jump ship and get stuck. Yeah. So lots of options.
Yep.
You guys good to move to the next slide? All right. So this is, I want to talk about, we've talked about a lot of these things post pre-sale. Now let's move to post-sale. So on our end, on the investing side, helping people manage money and come up with plans and things like this. Investing in retirement is completely different in a lot of respects than in investing for retirement. A lot of people, they're in accumulation phase. They go, look, I'm trying to make as much money as I can, whether it be in business, on the investing side, in stocks, bonds, whatever it may be. But you have to worry about a lot of different things in retirement than you worry about when you're trying to grow your money. I mean, it's really two big, huge, different kind of goals for a lot of people, and how you have to have a mindset. We tend to see a lot of business owners when they come into us, thinking about selling their business. There's usually, they're kind of potential polar opposites of each other. Most business owners, I feel like a lot of them, they are risk takers because they started their own business. They were their own boss. They're used to taking risks. So some of those people, they're coming in, they're going to sell their business, and they want to take a ton of risk in retirement on the investing side, because, hey, that's what they're used to. They're used to the risk. But you know what? That risk also was a lot more controlled in certain respects, because it was their own business. They dealt with the customers. They dealt with all that there was most of the items they could control. Obviously, there's certain items that are beyond your control, competitors and certain other things. But, it was you could say a quantifiable risk in certain respects. So they come in and they're wanting to take all sorts of risks. And then you have the flip side of that too, is you have the people, they might've been a risk taker in their business life, but now they're the exact opposite of, hey, I took all this risk, it paid off, I did well, but now I want to take absolutely zero risk whatsoever, because, I did what I needed to do and I want to be real safe. For most people, you need to be somewhere in the middle of that, because we were talking about healthcare earlier. Well, for retirees, the average inflation cost for a retiree is higher than the just general inflation cost across the average American because of healthcare. It's about, historically, if you look at it, the average inflation cost for a 65 plus year old is 4+% because of that, drastically increasing cost of healthcare. So it's something that we have to be concerned with. You may be okay today if it costs you $5,000 or $10,000 a month to live, whatever it may be. But if you're still doing well in 10, 15, 20 years, the cost of living goes up. I mean, I think we've all seen that in certain respects of our lives the last 6 months of what can happen to cost. And if you're on a fixed income, totally fixed income, or you have no flexibility in there, that can be very, very tough, because costs can go up. Now, it can go up quickly, it can go up slowly, but if you just look at it over a 5, 10, 15, 20 year period, generally everything tends to cost more. And so we really have to work with people to kind of come up with that happy medium of where we should be. And like I was saying, investing in retirement is completely different. And a big reason of it is because of this sequence of returns risk. Most people have, it's something that people like myself talk about, but, a lot of people haven't heard of this before. And if you want to go ahead and go to the next slide, I can, talk about it a little bit more. So sequence of returns risk is essentially this. If you have somebody that you invest $100,000 today, you never make any additional contributions or withdrawals. If you average 7-8% over a 20-year period, it doesn't matter if you have really good performance on the front end. It doesn't matter if you have really good performance on the back end, or bad on the front, bad on the back. As long as you average that 7% or that 8%, you're going to end up in the exact same spot. Now, of course, I'm ignoring taxes and potential other considerations, but just from a mathematical standpoint, if you put in investments today and you average a certain percentage over a length of time, you're going to end up in the same spot no matter where those returns occur. In retirement, it's completely different. I spend a lot of time with this on with clients because it's a real big concern for them. So what this chart is, and we've got a handout that I give to a lot of people, and this is just one of them, one of the charts that's in there. And this basically is going to reflect on, saying the people who are risk takers, and you get into retirement and you say, look, I want to take all sorts of risk. I'm 100% equity. So essentially what this chart looks at is, and these are true returns using the S&P from 89 to 2008. If somebody started with $1 million in 1989, you start taking out 5% a year, so $50,000. You index that for inflation by 3%, so it goes up, about $1,500 a year, at least on the front end. Where do you end up in 20 years? Well, if people on here remember investing in the late 80s, 90s, markets were pretty good there on the front end. Obviously, 2008 was bad. 2000, 2001, 2002, the markets were negative. But what you see here is over that time period when we, have the regular returns, which is in the blue line. If you started taking out that 5% a year, $50,000 on year one, you continue that all the way through 20 years into the future, you have $3.1 million. So you're very happy. You've taken out money all along, and you've got $2.1 million more than what you started with. Take the other situation where you've got the green line. It's the exact same set of returns. So when you look at it over a 20-year period, you've averaged the exact same thing in terms of rate of return performance, but it's just where did those returns occur? So obviously 2008, most people will remember that was the financial crisis. S&P was down about 38% that year. So you look at this on year one, you lose 37% off the bat, $370,000. And then you're taking out money all along. Well, you can never catch up. So that's the difference between good returns on the front end and bad returns on the front end is, you end up with $235,000 20 years into the future. Obviously, that's a significant difference. And, it's easy to look at this on a chart and say, hey, look, I at least I still got some money in 20 years into the future. But realistically, if you were to retire in 2008 and this happened, most people, they're not going to keep taking out that same amount of money. They're going to either try to go back to work, live on less. They're going to do a lot of different things, which that's probably not the retirement those people dreamed or imagined, when they sold their business or when they retired from work, whatever it may be. But this is a very big consideration. So you have to worry and take into account and come up with different tactics of, hey, look, do we need to be more income focused? So we're not going to have as much fluctuation in terms of equity markets, or do we need to have other reserves in place? So when, Apple is down, I'm not selling shares of Apple that was at, 140. Now it's at 100, because obviously if you need to pay that, your monthly bills, you have to sell a lot more shares when it's at 100 than you do at 140 to take the same amount out. So this is a big consideration that a lot of people overlook and don't think about, because, you invest one way for 40, 50 years, and then it totally changes kind of on its head. And so what we work a lot with people on is trying to figure out is, what do you really need to quote unquote retire and pay your bills? And, do we need $1 million, $2 million, $3 million to generate that monthly income that you need day in, day out? And then is there excess that we can then do some different things with? Because again, if it doesn't, markets aren't favorable early on, but pick up on the backside, well, if we're able to be more aggressive with a portion of that person's money, it's okay. That'll make up for any kind of shortfalls or gaps later on. So, if we know, hey, look, this pot of money here, this is going to last you in all likelihood 20, 25 years, hopefully for your entire lifetime, more than that. But we know we've got about a 20, 25 year period, worst case scenario that, this is going to last you. And then we've got some money over here on the side that is kind of going to offset if we have any shortfalls because we have weird returns like this or other unexpected things, whether it be, hey, I'm having to self-insure for long-term care. So I need something that has some big growth potential on the backside to help pay for those things. So I'm not having to sell my house. So I'm not having to go to my kids and ask for, money or whatever that may be. So this is just some of the considerations that we, have to sit down and talk with people and have a very full and frank conversation with them, because you can't necessarily expect the same returns throughout your entire portfolio in retirement as you're getting beforehand. So, if you use those same assumptions of, hey, the S&P's average 9 or 10%, so I'm going to use that assumption, I'm good, I can retire. If it works out well and you have the 89 to 2008 scenario, you're okay. But obviously, if you go the other way, it's a big problem.
Yeah, Mike, I've got a couple things to add there. One thing is it's completely different, from financial planners, right? I mean, the traditional financial planner that's going to build and accumulate money versus having wealth and preserving it. And I sold my business before I turned 40. And I remember we were working with kind of a traditional, very well-known financial planner, and they said, look, you're young, you keep 70%, 80% in equities, and put the rest in something a little bit more conservative, make up for it over time. It's easy to say. Emotionally, as you go through 2002, 2003, 2008, it's incredibly difficult. I look back now, and as I work with people, and this weekend we were in Utah for a wedding. I sat next to a friend of mine who sold his business. And before he sold it, he started to get involved in things. They bought a couple rental properties, good rental properties. They rent them on VRBO, Airbnb, stuff like that. And he was actually looking for another property in Deer Valley when we were out there. So he started this early and said, I wanted to change from this accumulation to income. So he changed his whole philosophy from stocks and bonds to, where I could, he bought some industrial properties, he got some Airbnbs, and now he's got that income coming in. Plus he's got the asset. He did, leverage some of them up a little bit. So he pays down a note while he builds up his equity. Completely different strategy, right? Sure. Then you have this traditional, what are your returns, your S&P 500 and everything. Because if you look at that, year 11 to year 13, I'm going to tell you what, I don't care how much you believe in 20-year, 30-year returns. When you go through that and you're looking and your portfolio is going down, you don't sleep at night. It's emotional. It's a roller coaster, and you don't want that, right? So it's really important to get with somebody that understands that. Another thing too is you become an accredited investor. You get to invest in different things, alternatives. Maybe an apartment project, a development project, stuff like that's going to throw off preferred returns backed by an asset, which are completely different than you're going to get by just sticking money into a mutual fund. So it's really important to get with financial planner who understands that other side. And we're focusing a little bit on selling a business. I think it's same as everyone changes into retirement, but you get this big chunk of money. It's different, right, than if you've accumulated slowly over time. And now all of a sudden, you want to protect that, preserve it, and throw income off it. So it's a completely different strategy that you have to have, and you really need to be with somebody that understands that, right? It's different.
I was going to chime in real quick too, just on the estate planning side. Another option you mentioned, Al, you get like a big chunk of money. You can do like a grantor annuity trust where you put in so much and then you get, it's an annuity payment. You get a guaranteed payment every month, or annual, whatever, however you set it up. And then there's money left over that you can either do it again, it can go to your kids. It's a little bit safer just to do, like, in addition to some of the other things you said. Just, it's a little more conservative, right?
Well, and too, we've harped on the capital gains side of it, but I mean, it's also, there's potential changes to the estate tax side that may come down the pike as well. So depending on values of business, I mean, that's a hard thing, I've had to have a lot of conversations with clients recently. It's like, look, the exemption is 11 million plus per person right now. You guys are more than fine, but all that really matters is what's the rule when you die. And hopefully, you're not going anywhere anytime soon. So, what the value of your business going to do in 5, 10, 15 years from now, because you're not planning on selling it maybe, or maybe you are, but what's the rule going to be then? Is it, a $3.5 million, a $5 million exemption? And now it's too late to do some of these planning techniques that would have been really good 10, 15 years ago.
Yeah.
And there's another thing too. If you transfer shares now, right, you're transferring at the current value.
Mhm.
And that current value is based on a financial return. And if down the road, you might sell to a strategic buyer. We worked with a client a couple of years ago, a real good friend of mine. I talked to him this morning. He had an exit of about $60 million. It was to a very strategic sale. His business wasn't worth at any given time probably more than $10, $15 million. So he can transfer those shares, pay your capital gains on that, they're done, right? And then if you do sell down the road, you've got that. So there's a lot of strategies that you can put in place if you start early on, right?
Right. I think that's the key. You just said right there, Al. You got to start early. What do you tell people? This is your area. How many years out do you usually recommend?
You can't start early enough, right? As you start to prepare and you start to think about these things, the stuff that we see later down the road is you'll see, if you're going to continue your business and run it, you're going to pass it to family members, then there's nothing wrong with being very aggressive on your deductions, right? I mean, you go to a conference in Aspen, you go to something in Palm Springs, you write it off, you have a couple cars in there, you do all this stuff. But as it gets closer to time to sell that, you don't get, it's harder to get credit for those. And banks aren't, you can't go to a bank, and a lot of, in our world, an acquisition sub $10 million is going to have some SBA funding to it. You can't go and say, well, are you saying you cheated on your taxes? And now you want to go and get an SBA loan? Well, it's the same government. You can't have it both ways. So these planning things, and it really catches people, a lot by surprise, right? So, and again, it just, that exit just completely, a lot of people, an ESOP are incredibly, tax favorable, but you've got a little window to really kind of fit in an ESOP, and you want to start doing stuff like that earlier. And each one's different, right? Some people want to retire and they just want to travel and that's it, and never look back. And others want to, hey, this is just, I'm going to get out of this one and get into something else, right? So it's very unique and it's very, very different for each person. But you want to plan it out. And you want to set that roadmap.
Yeah, roadmap. That's a good word for it. That's.
I'm going to add one more quick point there too. It's not as robust as what we've been talking about, but we discussed this earlier. From our perspective, from the exit advisor's angle, there are a few things that we also can do to help plan for your retirement from a transaction point of view. And a couple of these items are rolling over equity. So if you're exiting your business for 10, 20 plus $1 million, and that's a huge amount of capital to invest, definitely you need to put some of that in the market and find an advisor like Mike that can manage it. But rolling over 10, 20% of the equity back into the business with a new owner, if the buyer is, which typically in some cases they are, would allow you to do, what industry, what business do you know better than your own? and can have confidence in and kind of participate in, we call it the second bite of the apple, where maybe that 20% 5-10 years down the road might be worth the same amount that your initial liquidity event was. And then some small nuanced things that we can do too, finding owners that have a little more flexibility, that don't just completely want to walk away. If they're willing to stay somewhat engaged, put them on a salary with full benefits where they can have healthcare, 401k still for another year or two, just to kind of soften the initial blow with retirement. So there's a few things we can do from our angle as well. Anyways, didn't mean to interject, but Mike, continue, please.
Yeah, no, I mean, this is kind of the crux of it. I mean, it's just, and not to keep saying the same thing, but really, it's a planning thing. I mean, for everybody, it's very personal. You got to look at, we tell people, it's like, look, we need a budget on figuring out what do we need to do, because most people, they don't live like that. They just spend what they want to spend and move on down the road. But people have heard the phrase, garbage in, garbage out. Well, that's a very true statement. So, you mention budget to people sometimes, and it's not because I don't care what they spend their money on. Do whatever you want with it, but let's just make sure we're using good assumptions. And so to figure this stuff out on the front end and have these discussions, and work with your attorney, work with your CPA, working with whoever's helping you sell the business, to figure out, let's come up with some realistic numbers, because obviously there's a ton of variables out there that we need to be worried about, whether it be taxes, life expectancy, and we just deal with those kind of as they come due, with those changes and what's going on. But we want to at least give ourselves the best opportunity to succeed using the best information we've got available at the time.
There's another really important thing. We study it a lot. I've got to teach it a lot in my class, but it's this entrepreneurial burnout, where you hit this stage, it takes so much commitment, drive, you're passionate, and you're working every weekend, 70, 80 hours a week, going into it, and it's great, it's joy. And then it turns, it's kind of the drudgery of, all these things flying at you. I was in the printing business, and when we get upwards of 100 employees, there was always a problem. And it was always something coming at you. And, Heidi, you're an attorney, and you see legal stuff coming at you, this coming at you, an employee issue coming at you, employee problem coming at you. And as these things start to weigh on you, and you're still the leader in charge of, setting the tone, you can start to see this real decay and decline of value within a business. So timing is really important as well. Getting out at the right time before you kind of come off this edge. And like Andrew said, sometimes getting that next generation in there, that youth, that drive, and someone that's investing millions of dollars, they want to take that to the next level. If you can catch a piece of that, catch that second wave, can be another way to exit, but keep a little bit back in. But that kind of burnout phase it's really a big thing, it really is.
Yeah, no, you're exactly right on that, Al, because we see that a lot, where especially, we'll see times where the burnout comes in when things are, the person's been doing it for a long time. And then the burnout hits when, like a last year, when things are real tough because they're having to work even harder, they're making even less. And then they just say, I just want to be done. I just want to be out of here. And you really want to, set yourself up so hopefully that doesn't happen, because obviously if you have to sell, it's like anything else, if whether it be equity or business or whatever, in those markets, when things are down, you're only going to get pennies on the dollar for, whatever the business or the asset is. And so you want to set yourself up to where you don't have that. And so you got to look at those business cycles too, to say, look, where are we at in this business cycle? And that's part of, saving along through the years and other things, because you might not be fully ready to leave, but now may be the time, because we can see that there's issues on the horizon that you go, look, I don't want to hang on to this for another 2 years, because if I try hanging on to another for 2 years, I might have to hang on to it for 5, because, it's just, things are on the decline. So you really got to watch those, those issues and the swings in the economy and just the burnout and all those types of things. You got to be prepared for.
Right. I like the timing. That's key, right? sometimes your timing isn't quite right, but you just got to kind of go for it because it's right for the business, but maybe you weren't ready, or, but it's the right time, it's the right climate. And I agree with you. Like last year, there was a lot of people that said this is, wasn't going to retire this year, but I'm going to. This is the right timing. So if you're prepared ahead of time and you're planning for it, at least you could take advantage of something like that and not be caught unprepared, and then you can't take advantage of a good timing where if you're ready, then you could jump on it and move on. So that's a good point.
Well, if anyone has any specific questions, that we're about to hit the hour, so we're going to start wrapping it up. But go ahead, and if you have anything specific you want to ask, please do. And if not, or in the meantime, Mike, Al, and Heidi, maybe closing remarks, action plan. What should you do right now? Any final thoughts?
I mean, if you haven't started looking at these things, I mean, that's kind of what you need to start looking at, and start at least having internal discussions, honest discussions with yourself of, what's my end game here? What do I think I want to do? I mean, I don't think it's ever too soon for a business owner. Al, obviously, you mentioned your friend who he started the business knowing exactly who he was selling to on the front end. I mean, that's obviously probably not the normal case, but having those ideas of, look, if I ever needed to exit, or who I need to get this position to, be ready for those market timings and all those things. So you kind of want to, you're not going to be maybe always fully ready or have all these things completely fleshed out, but have a lot of this done, or, kind of available and ready to start looking at it if need be, because sometimes these opportunities or these items, come about, and you gotta, strike while the iron's hot and decide to sell or do something else, or, just be ready if, the owner, as the owner, have to step away. Well, what's going to happen to the business? Is my family taken care of? Is my spouse taken care of? With incapacity, death, whatever that may be. So there's just a lot of things that it's, you can never start too early.
Go ahead, Heidi.
Yeah, I would second that. No, thanks, Al. I would second that. Like, always, be prepared and go see someone like Exit Advisors. They'll help you get your business sale ready, so that if you have an unexpected event, like maybe even an incapacity, you're ready and somebody can take over. Or if you run into something that is a good deal and you just want to get out, or you want to do something else, you're ready. So I think that's really what I would say that my key takeaway or advice would be.
Yeah, I just echo what Mike said and Heidi said, and I just can't tell you the number of times. And sometimes we say we're kind of like a doctor, and somebody comes up to us, they're 60 years old and they've got high cholesterol, they're overweight, high blood pressure, and say, what can I do? And you say, maybe you should have started this 15, 20 years ago, right? And so it's a lot of that. As I get older, I find out that it's not one size fits all and everything, but it's, you want to understand your options, right? So, there's so many unknowns out there that, as you start to, we had somebody that was about 2 years out of selling their business, and they changed from a C Corp to an LLC. Well, C Corps, if you hold on to it over 5 years and it's founder's shares, you pay zero capital gains. So I said, do you realize what you did? You went from, well, everyone said C Corp's bad, blah, blah. Well, C Corp's bad unless you're 2 years out from selling and you happen to be a C Corp. So there's just so many different, there's different exit strategies and exit plans and everything. And I've got a friend that took money off the table and jumped into another industry because that's what he wanted to do. And others want to just retire and travel, and that's it. So it's unique, but there are a lot of different options, and there are a lot of different alternatives, and educate yourself on what those are, right? Because you probably have one chance to do it. It's unique when you own a privately held company. There's no market for those shares. It's probably your biggest investment, and you have one chance to do it right. That's it. All right. So.
Folks, thank you for your time. Mike, Heidi, Al.
Thank
Loved having you, and thank you to everybody for joining us. If you have specific questions, you want to reach out to either of us, our information's on the deck. It'll be sent out after we wrap this up, so you'll see it in the email. Oh yeah, and we have some upcoming events for August and September. Make sure to tune into these. They're ongoing education for everybody. Thanks, guys.
Thank you.
Thank you.